All right, what's up, everyone? In today's video, we're going to take a look at credit spreads and their relationship to the stock market. This is one of my favorite instruments to look at when it comes to market sentiment and looking for overall clues and insights into market direction, whether or not a move up or down is justified. And I'm going to explain how in today's video. Now, this is a market internals chart, right? A little bit also of a intermarket relationship chart. Now, this chart displays the relationship between the S&P 500 and credit spreads, represented by the ratio of the iShares 7 to 10-year Treasury Bond ETF, which is IEF ticker symbol, to the iShares iBoxx Investment Grade Corporate Bond ETF, LQD ticker symbol. Now, investors monitor credit spreads to assess market risk and sentiment. A widening credit spread, which is basically a rising IEF LQD ratio, suggests increasing risk aversion as investors demand higher yields for holding corporate bonds over safer treasuries. Now, conversely, narrowing spreads indicate greater risk appetite and confidence in the economic outlook. So you can use this and see how there's are divergences and how these two typically, will move inverse of each other. So the divergences between SPX and credit spreads can signal potential turning points. If SPX is rising while credit spreads are widening, it may indicate underlying economic concerns not yet reflected in equity prices. When you see confluence with credit spreads moving in the same direction, it suggests a more aligned market sentiment, either risk on or risk off. And really, I just mostly use this for trend analysis, if I'm being honest, right? The chart highlights period of trend alignment and divergence, helping investors gauge sustainability of equity market rallies or corrections based on underlying credit market conditions. All right. And so if we were to just go back and take a look at it, all right, and we come here and we look, we want these two to be moving in opposite directions to feel good about a move in the S&P 500. As our credit spreads ratio here is going down, we see this line chart going down here. What do we see, guys? Well, we actually see the S&P 500 going up and in an uptrend. So that's exactly, what we want to see, right? And as the S&P 500 is going down, what do we end up seeing, guys? Well, we see our credit spread measurement here rising on this chart, right? And we see going down here as the S&P 500 is going up. And so I look at these and I say, hey, well, if we look at this time period here specifically, right, and we were to start to highlight this, and we see that we had this large dramatic drop in the S&P 500 during this time period. And if we look basically during the same time period and we try to look at what credit spreads were doing, credit spreads were not starting a strong uptrend, right? We didn't see this credit spread ratio here really start to aggressively go to the upside or even make new highs as the S&P 500 was making new lows, right? We don't see a breakout above this resistance. We don't see a breakout above this resistance. So to me, this is saying, all right, well, maybe this is a little bit of fear, uncertainty, and doubt into the stock market. And potentially this is a buyable dip because I'm looking at my credit spread ratio chart here and my credit spread chart layout, and I'm seeing that the bond market is not very fearful. We're not seeing aggressive fear in the market justifying this sell-off as we have during this entire 3-year chart right here, where every time the S&P has been going down, we've been seeing an increase in our credit spreads ratio chart here, justifying that move to the downside. Right, so that's how you want to use this chart. That's how I like to use this chart. This is going to be one of the best measurements in charts to look at to really give yourself overall confidence in the trends that you're seeing in the market, right? If you're seeing, the credit spreads ratio rise as the stock market's going down, well, it's a very justified drop in the market. If you're seeing the market drop and you're not seeing this aggressive, move to the upside in this credit spreads measurement, well, then that could potentially be a signal that, hey, maybe this is an overreaction due to some type of external catalyst in the S&P 500, and maybe there's an opportunity to potentially buy the dip. Thanks for watching, and I'll see you in the next one.